Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors and we're not making any specific trade recommendation. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer simulated trades and or results in the presentation. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, welcome. My name is John Locke. I'm a trading performance and success coach with Locking Your Success LLC, and myself and my team are here to help traders win in the market and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, but not now in a moment, we're going to go over the winning trade. But before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning that we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they might be otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockingyoursuccess.com or ask us questions in the comments in the video, and we can direct you to where you can find more information. All right, let's move on. The winning trade that we're looking at today is called a bull trade, and this trade is amazingly simple. Now the bull's what we call a stage 1 trade in our trader success blueprint, meaning it's a beginner level strategy, but don't let the simplicity of the strategy fool you, because this strategy has a very impressive performance history of averaging 24% annual return since 2002, with years as high as a 65% return. And that's pretty impressive when you figure that most mutual funds were under 10% year over year for the same period. So here it is, the complete rule set. On the Wednesday closest to 65 days to expiration, we're going to enter a 30-point wing bullish vertical on the Russell that gets a credit of more than $2.50 per contract. Once we've entered the position, we're going to check it once a day when the market is down. If the market's stable, the market's going up, you really don't need to check anything. So if the market's up or flat, there's literally nothing to do. If it's down, then you're going to want to check that towards the end of the day. If the position drawdown when you check it is greater than the credit received, or about $2.50 per contract, then we'll exit the position. And our second exit is going to be when the next monthly trading cycle, or the monthly companion cycle if you're running weeklies, is 65 days to expiration, and that's it. It's extremely simple. Now this position requires a minimum of $2,750 per trade if you're trading it on the Russell, or if you'd like to trade with less capital, it can be done with as little as $275 on the IWM. Our exit loss trigger on this strategy is about $250 per contract when it's traded on the Russell, and only $25 per contract when it is traded on the IWM. The example we're going to demonstrate for you today is going to be 10 contracts on the Russell 2000. If we do the math, that gives us a trade size of $27,500, and an exit loss trigger is going to be 9% of that, which is, in this case, is going to be $2,500. In our demonstration, we're going to use an analytical software called OptionView, and we can back trade our strategies in OptionView, or we can show past trades in our strategy if we put the trades into the software. So the date we're going to start here is going to be Wednesday, August 14th, 2019. We always start our trades generally towards the end of the day. Of course, you can start them any time of day, but this is what we do in all of our sample trades. The index we're on is the Russell 2000. We're going to be dealing with our October 2019 expiration puts, which expire on October 18th, and we are currently 65 days to expiration according to our software. Now what you're looking at here is what we call a trade metrics. It shows our call options and it shows our put options at various strikes. If you're not sure what those are, that's okay. Within our programs, we tell you anything you need to know about options and trading and how this works. But for now, just realize that what we're going to do is we're going to sell 1310 strike put options, and we're going to go 30 points down and buy 1280 put options. This is going to give us a credit in this case of $3,300. That is more than $2.50 per contract, and that is fine. This is what our analyzed graph would look like, and I'm going to back this out a little bit. For those of you who haven't seen an analyzed graph, basically we have the asset price of the Russell 2000 along the bottom. We have our profit and loss in our vertical axis. We have a dotted line, which is a representation of what the profit is predicted to be or loss is predicted to be in the position at any given price level on the Russell 2000 as of today. It's called the T+0 line. And then we have what we call the expiration line, which is going to be the profit and loss on the trade at any given price point of the asset if the trade were to expire at that price. Now this expiration line, you can see these are the options that we sold at 1310. These are the options that we bought to cover our downside risk or to limit our downside risk at 1280. And basically what's going to happen here as time goes by, this dotted line's coming up to the solid line. And we can simulate that by putting another line in. So in other words, if we put 3 lines in, we have T+0, which is today. We have T+33, which is 33 days into the future. And we have T+65, which is basically an expiration. And that gives us a projection of our different values in the future. So you can see the line goes towards here. We can add more lines into here too. But you can see over time, our line rises. So if the market sits here, we make money. The market goes up, we make money. If the market goes down, we may still make money. We may break even, or it's possible we may take a loss, but the market would have to go down, or the Russell would have to go down a fairly substantial amount in order for that to happen. So that's how we can win going up, down, or sideways. Let me put this back to 2 lines. This is our entry position. In this matrix here, we can see our profit and loss. We have a loss right now of $30 on entry, and that's because we have to pay commissions on entry. And therefore, we start off a little bit underwater, as you do on all trades. And like I said, over time, or if the price moves up, we're generally going to gain. This delta number represents how much the position is estimated to win or lose with $1 price movement in a up direction. This gamma is how much our delta shifts. Our theta is how much we are projected to gain or lose in the position over the next day if the price doesn't move. And the vega is the position sensitivity to implied volatility, or the projected sensitivity to implied volatility. And let's look at the charting. And this is the situation we happen to be in a charting scenario. Now, there is no technical analysis involved in this. This is a high probability, market neutral, non-subjective trade that we're doing this particular month. But this does happen to be one of the better entries that we could have because the market's been down into a support level. It's likely, since it's been down a lot, it's likely to level off or go up. That's better than trying to put the position on when it's kind of at a top of a range. So we do like that, but it's not necessary because a lot of times we put it on the top of the range and it wins anyway, especially in an uptrending market. So this is where we start off. We are, like I said, 65 days to expiration. Let's just go ahead and just kind of hit this a week at a time. We'll go to August 22nd, which is only a week away. The Russell, if we look at the chart, has gone from down here at about 1460 up to here at about 1510. So it's gone up about 50 points, and that's actually a fairly large move for the Russell. We're up in a little more than a week. We're up about 1700. this is what our position looks like. If you'd like to go ahead another week here, the position kind of got beat up a little bit. We had, looks like maybe a market drop. Let's see here. If you look at the charts, we dropped back down. We tested our support range again. Notice the market actually went lower than it was when we entered, but because some time has passed by, we're actually up. We're still up a little bit of money in this. And that's what's really great when you do something this versus buying a stock or just buying an option in a direction. We can have that, and like I said, we can even go against this and we can still sometimes win. So here is where we stand. We're at $570. Keeping in mind that if you were managing this, okay, we put this trade on back when the market was down in this range, and really the market's essentially has not gone below our entry point. So you don't have to look at the position. You just look at the Russell 2000. You said, well, I know I entered the position when the Russell's at 1460, and today the Russell's at 1460. The market went up, the market went down, or it's above 1460. There's really nothing to look at. And realistically, you know, even if you go down to 1450, you don't have a problem. So as far as monitoring stuff like that, it's just knowing the asset price from day to day and not worrying about it. So really, really simple. But if we go another week here, we're back up. You can see the Russell has bounced. Let's take a look at the position here. So everything's looking nice. Now if we come back to our 1460 where we started, we would still be up $1,000 at this point. And as time goes by, that gets better and better. So that's what I love about that strategy. Let's move forward maybe another week. So we come all the way to September 11th. This is what the market has done. And we actually double bottomed here, and it kind of took off to the upside. We are up $2,970. Realistically, we never had to look at the position through the whole trade because the market really was never below our entry price. But now our November options are actually 65 days to expiration. Therefore, that is our trigger to close the position. So what we're going to do is simply put this trade in, and you'll execute that trade, and you'll be out of this for a profit probably after execution of somewhere around $2,900. So that is going to be approximately, or a little bit, approximately 11% of our planned capital. And all you had to do is enter the trade and exit the trade about 30 something days later. And that was the bull strategy, this episode's winning trade. If you like what you see, I encourage you to join us to discover how you too can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming trade presentations, and perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video and we can get those questions answered for you. And we'd also like to encourage you to come on over to thewinningtrade.com, where you can find episodes of the past winning trades as well as a lot of other fantastic bonus information and how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any questions you may have. Thank you, and we'll see you on the next winning trade.